Welcome back to another episode of Trade with Conviction. I'm your host, Felipe Elling Sherman, and today I'm joined by June, Phil, and Neil. Hey guys, how are you?
Hi everyone, all good here?
Good, thanks. Good morning.
Good, thank you.
Okay, let's start with the geopolitical corner. We need to start talking about Iran and the whiplash that happened over the last days. Obviously, last week was all about the risk premium with the Armada going to the US, but what a difference a week makes, and what a headache for anyone holding a length. The Abraham Lincoln carrier was parking in the Gulf, and the rhetoric was all about force. But the market was pricing in a war or a potential conflict, and earlier this week, the headline flipped to de-escalation. There were confirmed reports of US and Iranian officials meeting in Oman tomorrow, Friday, that triggered a massive peace trade sell-off. And we saw the Brent drop towards 66 as the market bet heavily on a deal. But then yesterday, on Wednesday, we got the whiplash. The board ripped back to 3% out of nowhere, and mainly driven by, I would say, two main reasons, two reality checks that hit the tape at the exact same time. To start with, we had this diplomatic wall where there were reports leaked that the talks were stalling before they even started, and the US wanted to include the ballistic missiles on the negotiations, whereas Iran only wanted to talk about the nuclear deal. The algo headline readers all obviously saw talks collapsing, and immediately the bid to the risk went back up. But then you had, while all of this diplomatic agenda was happening, the Abraham Lincoln had a live fire incident shooting down an Iranian drone that got a bit too close. Now, obviously, this sets us up to a binary kind of event for tomorrow. And if the talk shows some kind of progress, we expect the risk premium to unwind, likely testing the lower end of the recent range. However, if the talks stall or are cancelled, because there were talks about cancelling, changing venue and things like that, then the market will be forced to reprice the geopolitical risk, validating the move higher that we saw yesterday. Now, given this uncertainty, it's a difficult spot for a directional bet. And obviously, a lot of these events happen on the weekend. So prudence seems to be the right call here.
Yeah, the big news on Monday, once we got into the office, was the story about a US-India trade deal, if you like. Or there was essentially it was cutting tariffs partly in exchange for rejecting Russian oil. That's what Trump was saying, basically unilaterally. I suspected there was going to be something like that. It's not like that's a hot take, but it seemed like from the statements in the prior weeks, there was something in the works on that basis. And of course, on Monday, particularly me, I have the tendency to say, okay, what if this comes true? What is the end point? And of course, that would be very bullish for the spot Dubai market, for example. And June, you will go on to maybe talk about that a bit more. But it's a big potential volume. There's still something like a million barrels a day or potentially more of Russian crude that goes to India. And if that would be rejected and replaced with the spot market, that's a big deal. Now, of course, our skepticism should be kind of high. The kind of, what do you want to call it? The bullshit radar is high on various fronts this week. And so far, it's been mostly from Trump's side, and Modi has been quite silent on the thing. The bit that gets me more interested is just the connection with Venezuela, right? So Trump and the US has taken control of Venezuelan oil, essentially. They want to market it to India. So this stress on buying American, which includes now Venezuelan, I find quite an interesting coincidence, right? So I'm more tempted to say some more Venezuelan will go to India and less Russian will go to India. And that's an interesting sort of connection. And then there's the counter argument. It could still be pure theater. It could be connected to the Ukraine talks, which you'll go on to talk about, Felipe. And there's the counter argument that the Indians are kind of silent deliberately. One thing that's been written about this week is the fact that the midterms are actually approaching. The cycle starts in April, and Modi may well think to himself, well, actually, I want to continue buying Russian oil, and all I have to do is wait out a few more months. And then, the political picture in the US and Trump's domestic power will also look different within weeks and months, and he'll be distracted anyway.
I mean, I understand your skepticism in terms of the immediateness of anything happening, but this is all tied, we'll talk about Ukraine in a second, but it's all tied to Ukraine. It has everything to do with Ukraine and removing any kind of strength from Russia. It is not a coincidence that Europe signs a deal with India, and then now the US is signing a deal. They're all courting India to as much as possible. So because India can negotiate with the US or in Europe or can find a deal, whereas China will never. And that's the best way to weaken Russia. And they're all pushing for that. Interestingly enough, I was in Dubai this week and I met big Indian refiner. They were essentially telling me that Modi got all kinds of criticism from the parliament because he apparently signed the deal without the parliament approving it. And then so the Indian government was basically saying, well, we didn't sign a deal and say, oh, but Trump was announcing it. Yeah, but I cannot control Trump. And so there is a deal in the making, but it's not actually signed, according to what I heard. But again, so that's my point is that I think this is inevitable. It's going to happen. What I mean is the Indians buying less or no Russian crude. It's just a matter of when and what are the conditions and what can India get out of it, whether it's through the Europeans or the Americans.
I agree with you, Felipe. But when I was speaking to people yesterday, overwhelmingly, there's a lot of skepticism. So it feels like the market shrugs it off. But as you say, I think we should be open to the idea that the Indians maybe even half Russian imports again over the next few months. And that would be a big thing for the market.
And again, in part of this discussion is that we talked about last week's of the why are the Indians including all of these defense contracts in any kind of negotiation? And from what I understood is that over the last decades, if you want, Russia was the number one supplier of weaponry or defense material to India. They were even joking about the fact that, all of the documentation for, the tanks and weapons were in Cyrillic in Russian, so they heavily depended on Russia for everything that had to do with defense. So again, it's this time horizon that is the question mark. It's they need to, in order for them to be independent vis-a-vis China, independent vis-a-vis other countries, Pakistan, of course, naturally, they need to be able to replace these kind of weaponry and defense materials, and that might take time, and maybe only then they start switching on crude, or maybe they do it before because they have an engagement and a deal. I don't know. But all of this seems to be tied, and that makes me believe that it is inevitable, and it's just a matter of time. Because again, the big story is Ukraine. That is the real story here. And so there's peace talks in Abu Dhabi happening this week. So on the eve of the talks, Russia resumed large-scale air attacks on Ukraine cities. And assuming talks go nowhere this week, we can assume that Ukraine will start to hit Russia targets more frequently again. Well, this is, the Groundhog Day. We've seen this over the last years. But there seems to be a renewed optimism that we haven't seen over the last months, I would say. Since Zelensky's former chief of staff, Yermak, left, the negotiation team has changed, including someone called David Arkamia, who the Russians seem to respect. Another person that seems to be critical in making the positive momentum is Jared Kushner. So his involvement was actually applauded by Alexander Stubb, the Finnish prime minister. And according to him, his speech and his participation has had a very positive influence in the negotiations. It's worth mentioning that Jared Kushner is extremely well regarded generally, and he had, everyone can be skeptical because he's Trump's son-in-law, but let's not forget that he was behind the Abraham Accords when Trump was reigning the world in version 1. 4 or 5 years ago. Many commentators have sensed a change in mood in the Russian organization and with Russian negotiators. However, obviously the skepticism is still extremely high, and Russia almost needs this war now. It's a classic too big to fail situation, both economically and politically. And there's also the idea that the Russians, and perhaps even Trump, are again stalling for time, classic pure theater situation, trying to take the wind out of the sails of Europe, new interest in its own defense industry, and rapidly rising spending. This might be in the sort of conspiracy theories, but it is something to monitor for sure. Anyway, the bottom line is that oil will follow the headlines as usual, at least the flat price. So keep an eye on it. And unless you guys have any additional comments on Ukraine, we can move on to our bread and butter, the oil market. Should we start with you, Phil, on the light ends? Gasoline is rarely seen as a kind of bullish trade at this time of the year. But perhaps, Phil, you can give us a roundup of what we're seeing on the global gasoline market and if there's an opportunity there.
Sure. Thank you. I think we've definitely found a floor after recent lows. So end of January really saw markets globally in pretty steep contangos. That's obviously the Atlantic Basin, but also in the East. And over the last week or so, we've started to see a bit of a rebound. RBOB has been leading that resurgence, but I'm not quite sure that it's been fully justified, at least versus, let's say, EBOB. The weekly EIA data has been showing some pretty impressive builds, or steady at least, builds in recent weeks. And that is despite strong net exports. So definitely kind of supply has been strong in the US. Demand, at least in terms of those weekly data, not fantastic. And this has also come at a time where this higher TAR that we've seen over the last week has cut off the majority of LATAM ARB options out of the Gulf Coast, as well as any, let's say, West Coast Mexico or Pacific options as well. That's partly to do with just how strong freight is in the Gulf Coast as well. But overall, that picture of pretty supportive export options and relatively lower Pad 1 inventories that we were talking about earlier in January has completely disappeared now. Timing-wise, we can probably still see another week or so of decent Gulf Coast exports, but probably by the time we get into the second half of February now, that signal will have been in place long enough to see those exports falling again, and attention kind of has to turn back to Pad 1, where I've been building very quickly over the last few weeks, and probably should start to be ringing some alarm bells for how sustainable this latest uptick in the TAR really is. I'll talk about it again when we get to EBOB, but this very strong contango that we've had and these builds might be partly kind of the reason why we're seeing a little bit of more support in prompt spreads, but it's just shifting that pressure down the curve, as it were. Before I do get to EBOB, I'll just talk about what's happening in the Asian market as well, because we get plenty of questions about why exactly Sing 92 has been relatively weak. It's been kind of dragging a little bit on the broader Asian refining margins recently. And it seems to just be that there's a lot of supply around. We've had very few unexpected turnarounds or outages in refineries over the last 2 months or so. And at least anecdotally, we're hearing that buying isn't fantastic or hasn't been fantastic over the last couple of weeks. Things like kind of delayed Indonesian buying, where people would have typically been expecting them to already start their stock builds pre-Ramadan. Those tenders haven't been successful yet, but maybe they should come soon. So I don't think we're maybe ready for a rally just yet. Notably, we have very open Singapore 92 blend margins in Singapore, which is typically a bearish signal. So I'm not sure we can quite rally on Sing 92 spreads just yet, but there is certainly plenty of ARB support for the east of Suez more generally. The east-west is wide enough that there is no real pressure coming from any Atlantic Basin barrels, which you would usually get at this time of year. And the Chinese export margins on gasoline, and therefore their February export plans, are way down month on month in February. So some light at the end of the tunnel probably here. If we get to Europe, just to round it up, we're still in a very, very steep contango. But the run-up that we've had on the TAR recently is starting to help generate some ARB support, in addition to just actually what happens when you get a contango of that depth. So for context, Feb-March has hit about minus $9 a ton yesterday, which is, at least in recent memory, pretty unheard of levels of contango. And quality adjusted, obviously looking at kind of how you can blend a 60 kPa barrel now to how you could in April. We've got about a $25 a ton Feb to April carry, and about $12 a ton if you take it from March to April. So certainly still workable contango levels there. And looking at what that's doing to cash premiums, it's pretty unsurprising, I'd say, that we're seeing reformate and alkylate premiums ticking up in particular, as these are being pulled into storage for those kind of April and May barrels later. It means that we're getting prompt gas nap coming off and reformate premiums rising, which is a little bit unusual, but I think the storage play is essentially explaining that. So what that means is that this uptick in the TAR that we've seen and the high Gulf Coast freight means that there's some real daylight now between landed prices into Atlantic Basin destinations, between ARA and Gulf Coast origin. So we have this support now for the European market in terms of those ARB outlets. And the only kind of counter to that, I suppose, or the two counters to that, would be that the east-west is still wide enough that it's not that there are no outlets to the east. And we do have, obviously, Dangote coming back either this week or next with news about them kind of being confident potentially that they have debottlenecked the whole system, potentially adds a good 150,000 barrels a day of crude throughput, and a fully functional RFCC there is going to really help to at least keep offsetting the lack of or the lost capacity that we got from Europe last year. I've been talking for quite a while now. Hopefully,
yeah. Let me give you a breather here. Very good summary. It's a very interesting what you just said. Next week is IE week, and as you know, every single gasoline trader in Europe will be gathering at the pub, obsessing about March, April. What do you think is the right trade idea right now? To give them. I'm tempted to say, well, when you see these kind of historically low spreads and contango, etc., seems like a buy almost. Maybe there's little room for it to grow much higher, but it's very tempting. But what would you recommend?
Yeah, I think that seems like the most logical recommendation right now. Last year we had...
No. You just to buy, or to do what?
Well, exactly. to buy the prompt on the fact that we've got maintenance around the corner, and we have these signals from both storage and from the ARBs that should be tightening the prompt market at least, but then selling those deferred spreads as well. Because what we're doing is we're just shifting that pressure from now into Q2. And this happened last year. I remember we were at IE week and we were starting to see a decent kind of contango emerging. And I'm starting to kind of maybe think about pressure on April, May. But this year, that contango signal has been even earlier, right? We've had workable carry since about mid-January already. And April, May spreads are still positive, not by much, but they are still positive. So I think in terms of a trade, yes, there is room in the prompt for these spreads to come up a little bit as you start to tighten the market. But just have to bear in mind that April, May, even May, June, will have then that pressure of all of these barrels that are in storage being released when we get there. We don't know enough, probably, about exactly how heavy maintenance season is going to be. Obviously, you can always have some unexpected turnarounds. Maybe Dangote doesn't return, right? Maybe they try and turn it back on, and the whole thing collapses, and then you have your support. But without any kind of unexpected outages, I think you can fairly say that April, May in particular looks like it has some room to the downside from here.
What I find very interesting was what you said about adjusted contango, so summer to summer. At $25 a ton Feb April and $12 a ton March April, which if you compare that to the existing winter to winter contango that you have in Feb March at -9, which is already historically very low. That 12 contango seems, what it tells me is that indeed those cash premiums are too low, and they can, well, not too low, but there's room for it to grow. And simultaneously it's telling me that something's got to give. You cannot have a $12 contango in March, April for summer and then have a $1.50 backwardation. So I think that, your trade call is a very interesting one. Maybe not so much Feb, because we're in the middle of Feb.
We're in pricing, exactly.
Les jeux sont faits, as you say in casinos, but in March it's an interesting call. Let's see how it goes.
And just finally, we've also been getting kind of questions of, can you use the blender and figure out whether we can already blend and ship and store F1, so summer RBOB? The answer is almost. So probably not quite. I think that this storage signal is still much stronger in Europe than it is in the US. And it's probably linked to, we had a very tight period in European gasoline in kind of late Q3, Q4 last year. people are looking forwards, and a purely European balance is probably quite tight. And so that people will be, I suppose, expecting that to need those barrels when we get there. It just possibly the signal's been a bit overdone.
Mm. And by the way, I understood from a conversation I had yesterday that there was at least one Middle East alky cargo that was supposed to go to New York that was rerouted to Northwest Europe. So again, alky for summer, the contango in Europe paid more than the contango in the US. So, this story holds. Let's see. Let's put a pin on it and see if you were right in a month or something like that.
Cool.
June, let's move on to you on the crude market. What can you tell us about, we talked about India just recently. Can you tell us about India's crude buying pattern, and if we're already seeing any kind of signs of them halting Russian crude purchases?
So we look at, first of all, the trade flows. So far, reportedly, 1 million barrels per day of Russian oil is headed into India in Feb, another 800 KBD in March. And obviously, we just talked about it. There's no clear wind down period announced or even an outright deal signed properly officially from the Indian side. Even the refiners are seeking clarification right now. In the meantime, we have heard offers for euros below $10 per barrel below Brent on delivered basis into India, which is very, very steep discounts. So let's hypothesize if part of the trade deal is to take in more US energy. In this case, WTI comes to mind. Can that really replace euros, which is the majority of the barrels from this Russian crude? In terms of the yield profile of both of these crudes, it's very different. WTI is a light crude. It contains 28% fuel oil and 37% naphtha, compared to euros, which has 46% fuel oil and 20% naphtha. So it can't be one-for-one replacement. Yields-wise, the US crude that can replace is probably Mars or Poseidon, but it's not always economical and not always available either, unlike WTI, which is in abundance. So if we had to still take that WTI and bring it into India, it actually makes for a pretty good blend with Venezuelan crude, Mare, which is very heavy, but you might have a missing middle distillate portion when you do the blend. So it's not entirely one for one either. So in the meantime, we are going to see more AG crudes as a replacement first to the Russian oil. And if it makes sense in terms of econs, then we can see that Brazilian, Guyanan, and WAF medium crudes going in as well. At the moment, the price signal doesn't show that with sour crudes more in the money than sweet crudes. And therefore, AG currently seems to be the winner at the moment. We've already seen an indication 2 days ago when IOC awarded 4 million barrels of Murban instead of WAF crude from their tender.
So I didn't know that Trump was such an expert crude blender, combining WTI and Venezuela and selling it as part of a package to the Indians. Good. This guy is full of surprises. And June, can you shed a bit more light up to where we are on the East physical crude buying cycle, and what's special this month to watch out for?
At this point of recording, we are waiting for the Saudi OSP release. It's anytime soon already. Usually it comes out on the 5th of the month. The market consensus is that the Arab Light East OSP should go down by 50 to 80 cents per barrel, which would bring the outright Arab Light OSP into negatives. And that would represent the first time we are hitting this kind of numbers in 2.5 years. This downside in the OSP is based on the weak market structure that we saw last month with Dubai benchmark trading at negatives. So once these OSPs are out, the physical buyers will start to nominate for their term allocations for March loaders. Refineries with a view that the term prices are favorable versus the spot will go all in and flex their max tolerance versus the term contract. And within Sparta, we have the view that the spot AG cargo premiums will go up this month, and we'll explain a little bit when we go into our trade box section in a while. Then after that, the cargo allocations will come out around the second decade of the month, and that's when we will go into spot market for April loaders when we have the Qatar Energy tender. This month, it will be on Wednesday, 11 Feb.
And we're obviously approaching the Lunar New Year. Is there any effect to consider here?
For those who are not so aware, the Lunar New Year celebrations are starting from the 17th of Feb So effectively, the Eastern markets, not just China, but Korea, Japan, Asia Pac, will all be very quiet away for holidays from 16 to 18 Feb and maybe up to even the 20th of Feb. So 1 week of inactive trading. And additionally, we are in the buying window for Northwest Europe March maintenance period as well. So I'm expecting that the Western flows are abundant and waiting for the Eastern buyers to buy. So WAF traders out there, you need to watch out because your overhang barrels need to clear either before this Lunar New Year period or you have to wait for that 1 week.
That's a good piece of advice indeed. But I noticed that you haven't talked about WTI at all. Is there a reason for that?
Yeah, because the focus has been about the AG physical spot market, and the WTI cargoes are actually off cycle from this AG trading window. So like this week, we are looking at first half May arrivals already for WTI cargoes when Melbourne hasn't actually traded yet. So from a buying point of view, you need to take a position of WTI. At this moment, WTI is landing about $1.30 more expensive than Melbourne into the Far East. That's mainly freight driven. For example, the VLCC Galveston to Ningbo last quoted was at a whopping 14.8 million US dollars. So, the freight element is really causing WTI to be unattractive. However, we are expecting that freight should weaken in the near term. The open V counts in the 14-day window sits at 5 versus 0 a couple of weeks ago for this US Gulf Coast VLCC. And also from the TD22 RBI, which is the relative basket index, our Sparta methodology for checking whether the freight element is overvalued or undervalued and expected to fall or not. This TD22 RBI is now overvalued, implying that the US Gulf Coast Vs are expensive versus other load regions. And then on the other hand, we see WTI into Northwest Europe still looking pretty cheap. 40s and other North Sea grades are sitting at multi-month high premiums, no thanks to the strong DFL, and we expect it to correct in order to stay competitive versus WTI.
So before we move on to the quickfire, what would be your trade recommendation for this week then?
So I kind of alluded to it already, expecting spot AG diffs to go up in this trade cycle. We know we had a very weak January, but February should be significantly higher with positive premiums. So I will say why the reasons we think so. Number one, there will be higher demand from Indians switching out of potentially Russian oil. And while they probably try to source other crudes like American and Canadian, but AG is the most accessible one. Number two, the AG crudes was looking very cheap everywhere. Last check, Melbourne Up was actually still open to Northwest Europe, but that up is already shutting as we speak. So, that incentive is kind of coming off already. Number three, when we look at blending a light crude with high sulfur fuel oil, WTI and HSSR, it is currently $3 per barrel disadvantage versus medium crude upper Zakum. And it usually at this kind of levels, it should revert to mean, i.e. the UZ has been, the upper Zakum crude is too cheap already. It has to correct. The fourth reason is last month we saw Aramco trading pre-buying 14 million barrels of April loaders already of upper Zakum, and therefore reducing the supply of spot cargoes in this trading window. And my last reason is refining margins are still looking okay. I can't say very, very strong, but it's looking okay, and therefore has still ability to absorb a higher crude diff. Neil, you want to take the bear case?
I'll take the bear case, but for the record, I fully agree with June's assessment that I'm on the bull camp, but I'll read out the bear case. And the main argument is there's one, let's say, ARB-based argument against. We already see the Western crude market, the Western physical crude market starting to respond to the closed ARBs and more supply coming back from the likes of CPC. So my feeling is that the Western crude market will actually start to weaken a lot very quickly. Not just because there's more supply, not just because ARBs are closed, but it's also the timing in the year. So you can already see US crude runs are declining on turnarounds. European buying should also weaken as their turnarounds season starts to come in. Of course, we don't know exactly how big the turnarounds are going to be. There's rumors that it might be light, rumors that it might be heavy. But for my taste, the Western physical crude market will have a lot more room to run very quickly lower, and that should put a ceiling on where the spot AG diffs can actually go. And the second argument is a bit more speculative, I guess, The one is, what's the response of China just now? So we were just looking at some stats that we were getting a hold of. The Chinese stock building over October to January has been huge. We're talking more than 1 million barrels a day, probably, in terms of stock build on the back of high imports. And now that prices are higher, question is, what is their buying activity actually going to be? And then add in the fact that, it could be that they've taken a bit more Russian crude than they did before. Of course, they're replacing Venezuelan to a degree. But I wonder if the Chinese spot buying actually starts to weaken in the next cycle or two. So those are the two bear cases. But I'm fully on board in the short term with June's bull case.
Okay, well, let's move on to a quick fire round on the remaining products. So, June, maybe you can tell us a bit more about fuel oil, update this story about Venezuela, India.
All right. So if we think about the crude story for Venezuela, it's now heading to US Gulf Coast to fill up their cokers. That impacting basically the demand for VGO and AG/HSSR because you don't need such molecules as much as before, given that you can get it from the crude itself. So this is likely the case where we are seeing VGO and premiums, VGO premiums actually coming off in the market here. At the moment, the economics for shipping high sulfur from the AG to US Gulf Coast also looks very unfavorable. And this is the total opposite of what we saw late June last year until the end of 2025. We don't think that Saudis will stop importing Russian HSSR as well. Number one is econs, because it is the cheapest fuel oil for their power burn requirement. And also, we don't think that Trump will force Saudi's hand to stop Russian fuel oil imports into their country, given the importance it has in terms of Iran to the West. If I then look at the India side, if the India-US deal includes stopping the Russian HSSR flow into India, then the only outlets for Russian HSSR would be Saudi power gen, Chinese processing, and Southeast Asian bunkering. And this Saudi HSSR then goes to India.
Neil, moving on to you on the middle distillate side. What can you tell us about diesel?
Yeah, just two quick updates then. The first is the movement on the HOGO. I think we were relatively mixed but leaning bearish for HOGO last week, which turned out to be a relatively good call, but it was fairly obvious on the weather. But it is fairly high still. The interesting thing is the freight rates for bringing diesel from Gulf Coast to Northwest Europe. Those have been remarkably high, somewhat unsustainable in our view. And it had started to make that ARB less workable. But what's interesting this morning is also the fact that the Gulf Coast diff is starting to weaken again. So it feels like the ample supply in the Gulf Coast is actually winning out despite the freight being very bullish. And I think that's a fair assessment of the state of things just now. It's relatively tight in pad 1, loose in pad 3. And it feels like the reportedly high flows that we're seeing from the Gulf Coast into Europe are going to continue. And that's just a bit of a kind of structural change that we've been noticing over the last few weeks versus, let's say, in Q3, Q4. The other thing is just the movement on the east-west. So the prompt east-west, at least, had narrowed quite markedly over last week. The deferred ones are still quite wide and everything is still quite wide, but the prompt at least has come in a bit. And the interesting result of that has been that whilst we've had probably 3-4 weeks of the swing barrels from Sika pointing west, now we're in a much more marginal situation. So it's just something to think about in terms of where barrels are going to land towards the end of Q1 now, right? So we should have plenty, in theory, diesel on water heading to Europe because of the last 4 weeks of ARB. But in terms of late Q1, if this kind of pattern holds, it's something to add for the relatively more bullish case for ICE gas oil.
Okay, well, this wraps it up for us this week. Great to talk to you guys. Excited about next week. As you know, we have our first live podcast during IE Week. Please, if you like the pod and you want to participate, please join us. It would be great to see you. If you have any questions, don't hesitate to speak up and talk to us. And so thanks again, guys, for today. And looking forward to seeing you face to face next week.
Cheers. Bye-bye.
Good stuff.